All right. In terms of portfolio construction, is there ever a case for buying anything other than VEQT or the S&P 500? If a higher risk appetite existed, what other ETFs or assets would be recommended? Um, so I mean, I wouldn't just buy the S&P 500. I think that's the first thing that I would say here is that it's even though it has revenues from all over the world, which is the common argument for just investing in the S&P 500, I think it's got still got a lot of concentration. In the U.S. market, it's still companies that are subject to U.S. tax rates and financing costs, which are not diversified, even if the revenue streams are. Um, and to the specifics of the U.S. market, there's a question coming up, I think, on valuations in the U.S., which they're pretty high. I'm not predicting that U.S. market's going to crash, but valuations in the U.S. market are very high relative to history. So anyway, I wouldn't invest solely in the S&P 500. VEQT, on the other hand, is a globally diversified equity portfolio. It still has a decent chunk in the U.S., but it's also got a big chunk in Canada and in international developed and emerging markets. So that's fine, but it's also a 100% equity portfolio, which is not going to be right for everybody. I think you have to be aware of your ability to take risk, also your willingness to take risk, your comfort with volatility, all that kind of stuff. If a higher risk appetite existed, whether other, I mean, that's kind of our view on this is that tilting toward riskier stocks can make sense if you really want to take more risk. You can also use leverage with whatever your optimal portfolio you decide is. If you really want to take more risk, you can borrow a little bit of money to invest more in that thing. That, of course, comes with its own risks and complexities that people have to make sure they understand before doing it. But
Yeah, I think that's a great answer. I think, yeah, I agree that I wouldn't ever be 100% equity in one country. I think recency bias is driving a lot of this conversation about the S&P 500. And it's, yeah, sure, it's been a long time that the US has been doing really, really well, but there's other periods in history where you'd be crazy to invest only in US stocks just based on recent 5 to 7 year performance. So I'm not really convinced that the US is always and forever going to be the source of the highest returns around the world. Something like VEQT is great. And I think, Ben, one thing that should be really clear is when you're talking about more risk, you're talking about more compensated risk, right? Like you can take more risk by holding 2 stocks instead of 10,000, but you shouldn't expect higher returns from that. You should just expect a lot more volatility and dispersion. So how do you take compensated risk but increase the risk of the overall portfolio? And I think probably leverage is the best answer to that. Not a recommendation, because compliance is going to listen to this podcast. I am not recommending leverage. I'm just saying that's how you would kind of juice the returns if it worked out in the long run.
Well, I will say too, just kind of reading between the lines of this question, when somebody asks, or somebody implies that they have a higher risk appetite than 100% equity portfolio, the alarm bells go off for me, right? Because I want to know, you know, what exactly have you experienced in your investing life? Because if you lived through 2008 with a leveraged 100% equity portfolio, I'm sorry, but very, very few people can do that. It's extremely easy to overestimate your risk tolerance, and it's very easy to do it following a couple of years like we've just had in the markets. So, I mean, have you ever met anybody who you felt in order to meet their financial goals need to leverage 100% equity portfolio? I mean, they don't exist, I don't think. If you need to take that much risk, then you got other problems, right? And I'm not saying that to be derogatory. I just mean if you can't meet your financial goals with the expected return on a 100% equity portfolio, then the problem is more likely that you need to save more or expect to spend less or invest for a longer period of time. Taking more risk is not the answer there.
Yeah, that's a great answer.
yeah, I agree with that. I will mention uh, it's worth giving a nod to Scott Cederberg's research here, just on the question of what is risk. Like in this case, at least the way I read the question, it's kind of asking about risk framed as volatility. Um, but Scott Cederberg's research, and then also David Blanchett has a recent paper out looking at just how risk changes over very long periods of time. At very long horizons, like the 30-year horizon, volatility becomes a little bit less important, and the higher expected return of stocks actually, in some samples, makes them a little bit less risky than bonds, which tend to be more affected by inflation risk. Stocks tend to have negative autocorrelation, which means that after a recently bad period of returns, you tend to have a good period, and after a recently good period, you tend to have a bad period. That negative autocorrelation makes stocks a little bit less risky at long horizons. Bonds tend to have positive autocorrelation, where you have negative bond returns in real terms, usually due to high inflation. That tends to be persistent, meaning you tend to have a few years of really negative bond returns, which makes bonds a little bit more risky at very long horizons. So while bonds may be less volatile in the short term, they can actually be riskier at long horizons. But I mean, to your point, Dan, you still have to be able to live with your portfolio. And I don't know if people always appreciate what it feels like to live through a proper long-term downturn. Like a lot of people live through COVID and we're like, hey, that wasn't so bad.
It lasted 3 months. Yeah. And then, yeah, by the end of the year was, highly positive. Yeah. That's not what we're talking about. And it's a great point, though, about risk equals volatility, right? Because there are many types of risk. But I think volatility is the risk that makes people behave badly.
Yeah.
And
That's right.
That's the reason why you temper an all equity portfolio with fixed income. It's not because you want to reduce your long-term risk or you want to enhance your returns, because you won't be doing either of those things. But you will be dampening your short-term volatility, which is what gets most investors into trouble.
I think the other thing you pointed this out, Dan, is, it gets you thinking, like, what have they not been through? Like, what have they not seen in their portfolio? And I think often this type of question comes from somebody who usually is kind of younger, just getting started, and is trying to figure out how they can accumulate as much wealth as possible. And so somebody like that who does go through that type of event in the near term is likely going to do so with a smaller portfolio. And so even if they have gone through some kind of market volatility, the dollars may not have been that impactful. And they think to themselves, oh, that's easy. I lost 50% of my portfolio is only $3,000 at this point. Once you go through that with a 7-figure and 8-figure portfolio, if you get there, like the conversations with my clients are in dollar terms, right? It's like, we're down 40%. That's $4 million, right? So it's not, they don't think in percents as much as they do in nominal dollar terms, I find. And so I think there's very few people who are saying, how can I increase the risk on my portfolio if you've gone through an event like that with a reasonable sum of money?
For sure. Yeah.
So. Okay. Who's up next?
I'll take the next one. This question is from Al, but I have to admit, when I first saw it, I thought it said AI, and I thought it was like a, ChatGPT generated question, but it sounds like it's from a real human. So Al says he's 34, planning for the long term, and just starting his investing journey this year. And his question is on a lot of people's minds, I think. He says, given the overvaluation in the S&P 500 and the significant returns over the past few years, does it still make sense to stick with the asset allocation approach of allocating around 45% to U.S. markets, or would it be prudent to reduce this exposure? Probably the most popular question most of us are getting these days from clients and otherwise.
Yeah. And Ben, I bet you're going to have the longest and best answer to this. So I'll just go quick here. I think, one, we don't know that the US market is overvalued, right? I think we can probably only really say that it's highly valued, historically speaking, but overvalued, I think you can only really identify in hindsight. So I think that's an important distinction, right? We know it's expensive historically, but we don't know that it's overvalued, because overvalued assumes a correction is coming. And we don't know that that's going to be the case. And the rest of the question is kind of leading that idea, right? Thinking like, should we reduce risk because we're expecting a correction? We just don't know, right? I mean, the US market has been expensive for many, many years and still continues to go up. So by reducing your US equity, there's potentially an opportunity cost if markets do kind of keep going up. The other thing I think that is perhaps more important is that this individual is 34, planning for the long term, and just starting their investment journey this year. And so if they're really just getting started, going back to what I said in the previous answer, like, even if you're right and the US market crashes 50% tomorrow, the actual dollar term exposure that you have to that crash is not likely to be meaningful to you over the long run in terms of your financial plan. So I wouldn't if I'm just getting started in my journey, I wouldn't start trying to think about tactical asset allocation in my portfolio. I mean, we don't really use that even ourselves. And I don't think investors like that should get hung up on questions like this. I think like just get started, just go with an asset allocation ETF for some fund of your choosing, and just start putting money into it, and then just see how things go. But it's not likely, even if the market crashes, it's not likely to be meaningful to your long-term goals if you're just getting started.
Yeah. I think if it were obvious that the U.S. market were overvalued, its value would decrease, and we would see a correction back to whatever it should be. So I agree with you, Mark. You can't really say that it's overvalued. It's relative to its own history. It's highly valued. I was looking at the numbers for Japan this morning, just because this topic is coming up a lot right now. And I did actually do a Twitter post that maybe I shouldn't have done because it probably exacerbated this type of thinking from people. But I showed that there's only a few months in history where U.S. equity markets have been as highly valued in terms of the Shiller CAPE ratio, the cyclically adjusted price earnings ratio. Only been a handful of months in history where they were at their current level of valuation, at least on the day that I did the tweet, or higher. And all of those months were concentrated around the 1998 to 2000 period, where U.S. stocks went crazy during the dot-com, what ended up being bubble. We didn't necessarily know that at the time. And on average, in all of those handful of months where valuations have been as high as they are now, the 10-year forward return, the 10-year return following that starting month, has been on average negative, like it's negative 1.29% annualized for all those periods. So I mean, that's kind of scary, right? But to your point, Mark, we don't know if current valuations are high relative to the future. We only know that they're high relative to the past. And my little example there is a tiny sample, like it doesn't mean that much. I was poking around the data for Japan, and I just want to share a couple interesting points there. Japan, of course, famously had insanely high valuations, at least in hindsight, in the 80s, leading up to 1989 in December is when they had a crash. I don't know if people are familiar with the story, but if you invested in Japanese stocks in December 1989 and held them until now, I think your annualized return in nominal terms was about 1%. I think it might have been 1.19% annualized. But in any case, very, very low. And adjust for inflation, adjust for treasury bill returns, it was a negative return. So not very good over such a long period of time. That's December 1989 until November 2024. So that's a very long period to not get any returns from stocks. Now, on the way up, though, and this is the part that's interesting to think about in the context of U.S. valuations, if you look in like June 1985, Shiller CAPE for Japanese stocks was about 38, which is roughly where it is now. If you look at the 10-year returns starting from that point, Japanese stocks actually beat world, excluding Japan, stocks for the following 10 years by about 90 basis points annualized. So, valuations can be really high and you can still have positive returns. And in that case, you can still have returns that beat other geographic regions.
And that assumes you invested your entire stack in Japan, all at once in Japan and never bought again, right? And so I think, especially with this individual and asking this question, they're 34 and just getting started, like ideally you're going to be putting money to work every single time you have available money to invest. And so if the US market does have a correction in a big way, you're going to be accumulating, hopefully.
You should almost be happy.
Yeah, exactly. Right. Like you're going to be hopefully be buying at those levels, and it's the average price over time that really matters. So like, unless you just received a $10 million lottery win and need to allocate all of it today, I just don't think it's an impactful outcome over the long run, even if the markets do correct.
Yeah. Anyways, I think my Japan example just kind of shows that, like,
totally.
Yeah, U.S. market is very expensive in terms of its valuations relative to its own history, but that doesn't mean they can't go higher. And there's a non-zero chance that they go a lot higher, and you end up missing out on a bunch of returns. We can't predict the peak. We don't know when it's going to turn around or if it's going to turn around. So I mean, the other possibility is that the fundamentals, like the earnings side of that equation of the Shiller Cape, grows so much that valuations aren't so high anymore, and we don't have a big crash. Um, there are lots of different possible outcomes. I think people worry a lot about this, but probably not as concerning as people.
Or that could happen, and the Canadian dollar could drop more than USD, which offsets some of the losses too, right? Like you've got, if you're holding, US risk, like there's other potential sources of returns and risk there that can offset. Was it 20? I can't remember when it was, 2016 or something, 2015. I think US markets were flat, but USD was up 20%. So like you're up 20% just on the currency. So there's lots of stuff that can happen, right?
All right, should we do like 2 more questions?
Sure.
Sounds good.
Gotten to 18, so we definitely wouldn't have gotten through 161. There's no hope there.
I think we were like, oh, we can probably get through half and like make it a 2-part episode. No, we got through like what, an 1/8.
Well, I think what we can do is we can make a segment going forward. We can add a segment on like AMA questions, and we can just pull from this list until it's exhausted, and then maybe refresh it. I don't know. We'll see how long that lasts us.
Yep.
All right. What have been your most significant investment mistakes, and what valuable lessons did you learn from them? You guys want to go?
I've never made a mistake.
Nice.
Not surprised.
So no, I'll take that one first. I would say that I was actually fortunate, just that the way my life unfolded was I didn't really have much money to invest until I had already learned about it. In other words, I didn't invest a lot of money when I was young, and then realized 20 years later that I was doing it all wrong. But I would say when I first started to learn about sensible investing, my biggest mistake was tinkering. So I was in pursuit of what's the optimal portfolio. And of course, at that time, asset allocation ETFs didn't exist. So I was building my portfolio from individual ETFs, and I was like, I have to have 7.2% commodities, and I have to have, this, that. And I had, like a 10, 12 ETF portfolio with my $50,000 or whatever I had at the time. And eventually I realized this is all a massive waste of time, energy, and money. And I needed to focus on simplicity, saving more, and sticking to a disciplined plan without, tinkering with it. And it took me a little while to get there, but once I did, I have found it very easy to stick to it, because intellectually I know why it's the right thing. And also I happen to not have that gene. Like I've never bought an individual stock. I'm not interested in speculation of any kind. So that part's easy, but it did take me a while to get used to the idea that, most of the tiny details don't matter as much as the big picture does.
Great answer.
Yep. Am I next?
Mark?
Yeah.
Triple leveraged Bitcoin.
Have either of you guys ever been margin called before?
No.
Okay.
Oh.
You've never, really? Just me?
Nope.
Just me. Yeah. So there was a period in my life where I was selling put options, the cash secured puts. And without getting into a big explainer about it, basically you're making if you're selling a put, you are selling the obligation to purchase a stock at a certain price. And so let's just say you love Apple at, I'm just making up numbers, I don't even know what Apple trades for, but you love Apple at $100 a share, you sell a put at 80, and you collect a premium. So you collect $2 on that. And it's a 4-week contract, let's say. And as long as Apple doesn't go to 80 or below during that 4 weeks, you get to collect your $2 in premium and you move on to the next contract. If it does go to $80, you get exercised and you have to buy the stock at $80, which actually the narrative goes, that's a great thing, right? Because now you're buying a stock that you like anyway at a steep discount. What could go wrong? Well, the stocks can stay down for a very significant period of time. The stocks can blow through $80 and you're buying them at 80, but now they're trading at $50 and they stay there perpetually. And it's one thing if you're doing this cash secured, meaning in that example, you have the $80 available to actually buy the stock when it's assigned to you. And so that would be the more intelligent way I would suggest to do something like this. But you can also do something called naked selling. In case you guys didn't know this, you can do that and not have the money If it goes to $80 and you don't have the money to buy the stock in your account, then you can get margin called. And margin call means basically like you need to put more money in your account or we're liquidating you and you're going to lose a lot of money. So I've been through that, which is really fun for me. Not stressful at all. Thought I might lose my house and my family was going to disown me, but other than that, like came out of it okay. And here we are. So yeah, don't sell naked put options on stocks, especially if the market's going to crash. You'll have a bad time.
Pop that one, Ben.
I think I might have a worse one.
Oh yeah.
Uh-oh.
In two instances, people that I knew well enough who have had successful exits before, meaning that they started a company, raised money, and then either went public or otherwise sold and did quite well for themselves. We're raising capital for new businesses. And I knew these guys had exits in the past. I knew they were very financially successful. And because I knew them well enough, I guess they asked, "Hey, do you want to invest in this thing? We're doing this thing." They told me what the company was about. And this is years ago now. And I don't know, I felt like that was a kind of a cool thing to do. And I had a little bit more income that I'd had when I was younger, and I couldn't afford to do something like this. So I thought I think I'll do this. This is what smart people do. Both of them went to zero. Very unsuccessful. I don't know if it's, I guess, an angel investment type thing, but yeah, I don't want to describe the types of businesses they were, but yeah, I'm a very unsuccessful angel investor.
But without describing the type of businesses, would you say, is that kind of outcome bias in that, lots of businesses go to zero, not because they were terrible, but just because they were unsuccessful. And that's part of the risk of investing in, a startup. It doesn't necessarily mean you made a profound mistake based on the information you had at the time. Or was it more that just, I trusted these guys, I didn't even look at the business plan? Of course,
I looked at the business plan in both cases, and in one case, there was I don't know, I'd call it a company specific issue where they ended up going into another, or they raised money for one business, and then they were acquired by another business, and then there was a conflict between management of those two firms, and that caused enough issues that they had a lot of trouble. That company still exists, but they were, at one point they were listed, they've been delisted, and anyway, it's currently worth nothing. It might be worth something at some point, but still not a great outcome. So that was a very company specific issue. And then the other one was an industry issue where they were building a business in an industry that could have done very well, and that asset prices in that industry just completely tanked for a period of time while they were building their business. And that, I think, really decreased their ability to access capital. They ended up having to do another raise at some point, and there was just nothing there for them. And so they ended up folding for that reason. So two different reasons for the bad outcome. I think both were smart business ideas, and they were being run by groups of very, very smart people. But yeah, I mean, just goes to show you that there are a lot of things that can go wrong when you're investing in one thing, especially an early stage company.
I mean, the cool thing though is that you can put angel investor in your LinkedIn bio now, Ben.
Yeah, I could do that. Then people might ask me about my investments though.
True.
Unsuccessful angel investor.
Only talk about your winners. That's rule number one.
We do one more.
Yeah. There's two insurance questions here back to back. So I don't know if you want to just take both of them and then call it a day. What do you think?
Yeah, sure.
I'll read it. What are your thoughts on life insurance? Would you recommend a young Canadian couple with a new baby who have not yet maxed out TFSA, FHSA, and RRSP room, no RESP, to implement what we call infinite banking with life insurance? I already know your answer, but was hoping to understand your rationale on this. So, Ben, I know you've been working on something with respect to infinite banking. I've got my own thoughts on this as well, but I think, Ben, it's probably pretty fresh for you, what you think about infinite banking.
Yeah, sure. So infinite banking is the idea that you can buy a participating whole life policy, and you can overfund it. You can put more money in than is required to pay premiums. And those deposits, the cash value of the policy will then accrue participating policy dividends, which increases the overall cash value, and that compounds over time, which is great. And then you can borrow against your cash value from the insurance company. And the amount that you borrow, you pay interest on to the insurance company, and that interest goes back into the participating pool, which is why it's called infinite banking, because you're paying interest to yourself is the way that it's sold. I don't think it's much more complicated than that, but that's the way that it's sold. So what would it make? Does it make sense to do that instead of invest in the registered accounts that this person mentioned? In the modeling that we've done on this, it is really, really hard for an insurance policy to come close to matching the expected outcome of any of those account types: TFSA, FHSA, RSP, and or ESP. The reason being that the expected returns inside of an insurance policy tend to be relatively low. A participating life insurance policy can look a little bit better, but there's also risk in that case because the participating policy dividends are not necessarily going to be as high as they have been in the past or as they're currently illustrated at. So when you purchase one of these policies, it'll be shown what's called an illustration, which is like a projection of the future, how the policy is going to look in the future. And that'll be based on the current dividend scale, which is like the participating policy rate, dividend rate that was most recently paid, I think. But it's always really important to ask to see those illustrations at current dividend scale -1% and current dividend scale -2%, because the current dividend scale is not guaranteed. And over the last 20 or so years, policy dividend rates have had decreased. They've actually come back up a little bit now, but it's not a guaranteed thing. So the idea is everybody needs financing throughout their lives, and the best way to do it is through this. I don't think that's true. I think that you can invest in your registered accounts, which are tax preferred in various ways. The RESP, you get additional grants and bonds in some cases from the government, which make it really, really hard for an insurance policy to match it. And I mean, you can meet your financing needs with traditional means of financing, like taking a vehicle loan or leasing a vehicle instead of taking a policy loan. And I think that's a perfectly reasonable alternative. When you read the book, there's a book called Becoming Your Own Banker. That's kind of the whole foundation of infinite banking as a concept. The thing that I found most striking about it, and this isn't the best way to argue against it, but I think it's important. The thing that I found most striking about it is that it's extremely ideological. Like, it's not so much about this is a really smart financial strategy and this is going to give you a better expected outcome. It's like, you don't want to pay interest to the bank. You want to pay it to yourself. And there's a lot more anti-government sort of almost conspiracy level language in that book. But I think that colors a lot of the logic of the strategy as a whole. But when you run the numbers, which we've done, which for a paper that I'm working on with Jason Pereira, it's really hard to make insurance match the expected outcome of investing in registered accounts. Anyway, so that paper's still a work in progress. Hopefully we'll do a more detailed explanation of our results. We've still got to work on a few modifications to the cases, but in general, I think the statement that it's difficult for a permanent insurance policy to match the expected outcome of investing in a registered account and accessing financing through traditional means, I think that's going to hold true in most cases.
Yeah, I mean, to step back and just not address the specific question about infinite banking, but looking at the first part of this listener's question, what would you recommend for a young Canadian couple with a new baby who have not yet maxed out registered accounts, et cetera, et cetera? Get cheap term life insurance. I mean, that has to be your number one consideration. Disaster proof your life, as Preet Banerjee used to put it in his book, because that's the idea, is that you've got to look after that before you start investing, right? Because that's If you procrastinate on the insurance until after you've maxed your registered accounts, you might never get there. And then, of course, the other encouraging part about all this, it's a lot easier to get cheap term insurance when if you're a young, healthy
Yeah.
couple with a new baby than it is to start worrying about maxing registered accounts. So don't get fancy with this. Get cheap term insurance to cover all of the contingencies that you can imagine. And you can worry about these more advanced strategies later if they're really that important to you and if they really turn out to be advantageous, but it's not what you need right now.
Yeah, that's great.
Yeah, I think the other thing I'll say, and this is maybe some kind of logical fallacy, but I'll say it anyway, is of all of the great fee only or fee based financial planners I know, and I make that distinction because I mean, of all the great planners I know who are not purely insurance sales folks, I don't know a single one that has an infinite banking policy themselves, right? I don't have one. I don't have permanent insurance myself. I see no need for it. And I find it's very telling that the people who know about financial planning and not just insurance generally, and I'm sure there's people who are going to message saying that's not true and I have a policy, but I've never met somebody who does use infinite banking. And these are from people who could sell you infinite banking if it was optimal, but also are not, are not biased towards it because it's not their only source of income. So I think that's a very telling point. And then, like, to your point, like TFSA, FHSA, RSP, RESP, like you don't need to jump through hoops to use these accounts. They're right there for you. They're very easy to open. You can implement these in a low cost way. For the most part, these are very, very liquid as well. And you're not locking yourself into any sort of long-term contract like you are kind of with whole life. Like there's a lot of downside to the lack of flexibility that comes with these types of policies. And yes, the liquidity comes from you being able to borrow against it, but then you're just introducing interest rate risk to your plan as well, because if interest rates go up and dividends and paid up insurance amounts don't keep up, you can end up in a problem where you're starting to exceed the allowable level of cash value and interest in the policy. So there's a whole bunch of downside risks that I think, in my experience, those who sell this type of stuff rarely talk about, like lower than expected dividends, interest rate risk, lack of liquidity, and being locked into something for a longer period of time. So yeah, there's very few circumstances where I think it's optimal. And as we've said all episodes, like the whole episode, do you know anybody that didn't meet their financial goals because they didn't implement infinite banking? No.
Yeah. I will say that it's not a totally insane strategy. Like in the modeling that we've done on it, it's not horrible. Like you're not necessarily throwing your money away, and it can work, I'm sure, for the right person. So if it's a strategy that really speaks to you for whatever reason, and it's going to allow you to be disciplined more so than you would otherwise, I mean, hey, that's fine, I guess. But I think it probably is suboptimal for most people most of the time. And I think it's really important. You mentioned it, Mark, that a permanent insurance policy is a contract that you're entering into, and breaking that contract, like if you decided to cancel the policy, it can be really expensive, especially early on. So those considerations are really important. Buying cheap term insurance for your life insurance needs and investing in your registered accounts is much more flexible. You don't have a contractual obligation. Now, a counter argument to that is that you don't have a contractual obligation. The insurance policy might encourage discipline, which for some people, maybe that's important. But I think that that philosophy, that strategy is generally oversold by people who are, in my experience, only insurance licensed. And if it works for some people, that's fine. But I think it would be wise for people who are being pitched that strategy to look for alternative perspectives, just to understand the potential downsides. Not that it's a terrible strategy that nobody should ever do, but I think you have to hear information about it from someone who's not biased to give you a certain view.
One more? Last one?
Yeah, you can answer this one. I'll read it. You answer it.
Sure.
Mark.
Okay.
Parents bought whole life insurance for their child. The child is now an adult, 33 years old. Should the child take over the policy or do a cash surrender? What are the considerations? Or is there someone unbiased that we can recommend they talk to?
Mm-hmm. Yeah, so I actually got whole life quotes for my own two kids last year. I think there's a point where this becomes an interesting strategy, but this is they've already done it, right? So parents bought it for the child, and the child is now 33 years old. So one of the things that's really I think potentially attractive about this type of thing is that the policy can be transferred to the adult child. They can take over ownership of the policy, and that's not a taxable disposition necessarily. Oftentimes, if you were to transfer an insurance policy between like arm's length parties or between a corporation and an individual, it's a taxable disposition. But in the case where you're transferring it to children, I think as long as they're the ones who are insured under the policy, I want to say, going from memory there, then it's not a taxable disposition. So you're getting permanent life insurance for your kids at a very young age, which makes it relatively cost effective, ensures that they have some insurance in case, something happens health wise as they get older and they're young adults and they have some kind of health problems and wouldn't otherwise qualify. Well, at least you've got this insurance in place, and then you can transfer it to them and they can take over the policy, and that's not a taxable disposition. So, we can't say for certain because we don't have the full picture of why this insurance was purchased in the first place, what the, we don't know anything about their financial situation. What would they do with this policy if you were to transfer it? Would they keep it? Would they borrow against it? Would they cash it in? Are you concerned that they might do that and you want to hold it back and make sure that they don't have access to the money? We don't know. But it's certainly a consideration. And I think in the right case, assuming that child who's the life insured has reached some kind of financial maturity, and if there's still premium payments required, they can take over the premium payments. I think it's totally reasonable to transfer it to them. But this was ideally bought under some kind of goal or plan. So I'd be curious to know why they bought it in the first place, and if it makes sense to transfer it to them. Tons of great insurance advisors out here. I won't name drop on this episode, but this is a question from Alexis. So Alexis, if you're listening, feel free to reach out to me on LinkedIn or Twitter. Just send me an email and I can give you some recommendations to unbiased advisors that you can talk to about that. Dan, I don't know if you've got much experience in these types of policies, but
No, I mean, to your comment about this was obviously done with some kind of long-term plan. I mean, maybe,
right.
or maybe the policy was just sold to them inappropriately. I mean, who knows? I mean, and
Never happens.
insurance is one of those things too that, the answer is virtually always it depends, in the sense that the 33-year-old in question here, I mean, what's their situation now? Do they need permanent life insurance? What's their health like? Right. I mean, obviously, if you've had a diagnosis in the past or you find yourself more or less uninsurable, of course you should take the policy, take it over and continue it. If you don't need permanent insurance and you're in a situation in your life where it might make sense to take the cash surrender value, get cheap term insurance, do something productive with the cash surrender value, that's important too.
Mm-hmm.
There's lots of possible answers here that we can't possibly know without understanding the circumstances, but
yeah, agreed. And one thing maybe to consider is that to surrender the policy and withdraw the cash value could be taxable as well. Basically, the cash value of the policy minus its adjusted cost base. And if the policy has been enforced that long, it's likely the adjusted cost base is relatively low, and we don't know how big this particular policy is. But the excess of the cash value minus the adjusted cost basis is taxable when you withdraw it, and it's taxed as income, not a capital gain. So surrendering it could be a tax event that they aren't aware of or weren't prepared for. So something to keep in mind.